Hey everyone, welcome back to Corporate Decoder, the place where we dig through corporate filings so you don't have to. Today we're decoding the latest 10K from Crescent Private Credit Income Corp, and let me tell you, after reading this, I definitely need some income, private or otherwise. Crescent Private Credit Income Corp filed their annual report called a 10K, and here's the summary. They aim to give you current income with a little long-term growth sprinkled in by investing in debt and related investments of mostly US middle-market companies. Before we dive into the numbers, it's important to note that this report contains forward-looking statements, which are basically educated guesses about the future. The company warns not to rely too heavily on these as things can change. They list a bunch of things that could make their predictions wrong, such as changes in interest rates, economic recessions, or even the conflict in the Middle East. They even point out keywords like anticipates, expects, or believes to help you spot these predictions. It's a standard disclaimer, but worth keeping in mind. Let's talk risks because every investment has them. Crescent admits they have a limited operating history and that their board of directors can change investment strategies without asking stockholders first. They are dependent on key people of Crescent and their investment advisor, and they may not replicate the historical performance achieved by Crescent. Plus, there are potential conflicts of interest because the same people managing our money are also managing money for other companies. So, it could affect how they choose investments for us. Something else to keep in mind is that they're a non-diversified investment company. That just means they can put a large chunk of our money into a small number of companies. If one of those companies tanks, it could hurt the value of the whole portfolio. Now, how does Crescent actually make money? Well, they get a management fee, which is a percentage of our net assets, whether we make money or not. They can also get incentive fees based on our income and capital gains. This fee structure might tempt them to make riskier bets to boost their own earnings. So what's their game plan? Well, they normally invest at least 80% of their total assets in what they called private credit investments. This means the loans, bonds, and other debt given to private companies. While they can invest in larger or smaller companies, the primary focus is companies with EBITDA of $35 million to $120 million. That's a measure of profit. They also invest in liquid credit, which is just debt that can be easily bought and sold, and also in non-US companies. The company depends on help from its advisor to succeed. The departure or misconduct of any of these individuals could have a material adverse effect on our business, financial condition, or results of operations. As a BDC, the company can be limited with its co-investments and joint transactions with its affiliates, meaning they are subject to restrictions of making certain investments with related companies. The relief permit allows the company to invest with other investment funds, accounts, and investment vehicles under circumstances in which such investments would otherwise not be permitted by the Investment Company Act. Because they're structured as a BDC or business development company, some rules impact how they can raise money. Also, they have to invest a certain amount in qualifying assets, which are mostly loans to smaller, private US companies. If they don't, the company might not be able to take advantage of attractive investments. How do they plan to make us money on these investments? Mostly through refinancing, where the portfolio companies get new loans to pay us back, or through sales of those companies, or in some cases, initial public offerings on the stock market. Let's move on to how Crescent actually picks these investments. It all starts with figuring out what's going on in the global economy. Then, they do a deep dive into individual companies, looking at things like their market position, management team, and financial health. This process is used for almost all new issues in the bank loan and high-yield bond markets. If an investment looks promising, Crescent does more digging, which can involve checking credit, visiting the company, and talking to management. They develop the structure of an investment, including negotiating among these parties on how the investment is expected to perform relative to the other forms of capital in its capital structure. After investing, they actively track their investments, giving each one a risk rating from 1 to 5, with 1 being the least risky and 5 being the most risky. Now to their financial results. Their total investment income for this year was $23.6 million, and they made some calculations and said that their net expenses came to $9.4 million, and that means they were able to come out with $14.2 million in profit. They also mentioned unrealized gains or losses of $1.4 million. Something that helped their results is an expense support agreement that they have with the advisor. With this agreement, the investment advisor may elect to pay expense payments on our behalf. This helps the company make future distributions to common stockholders. The primary investments are senior secured first lien 48.3% and unitranche first lien 46.3%. The weighted average yield on the debt they hold is 9.5%. But what about the future? The primary uses of our cash will be for investments in portfolio companies, operating costs, debt service, and distributions to stockholders. Before we wrap up, there's some housekeeping required. We have to incorporate portions of the registrant's proxy statement for the 2025 annual meeting of stockholders. Overall, what's my take on this? Crescent has a strong foundation with its experienced team and established investment process. However, several risks are worth considering. The limited operating history and potential for conflicts of interest create some uncertainty. On top of this, there was no established public market, and 6,991,873 shares of Class I common stock. The reliance on external management also means the company's performance is heavily tied to Crescent. As a result, a significant amount of attention needs to be paid to outside factors such as the effect of global climate change and the financial health of the United States, Europe, and China. Finally, investors should be aware that they may experience dilution if they opt out of the distribution reinvestment plan. One other thing, like any company these days, they're worried about cybersecurity. They are not aware of any cybersecurity risks that are reasonably likely to materially affect their business. So Crescent seems to be heading in a generally positive direction, riding off the expertise of Crescent's team, especially in a rising rate environment. The lack of debt to be paid off for now and the ability to meet the qualifications of the RIC should allow the company to continue into its growth phase. However, there are several items that must be given attention to from investors as the company continues. Thanks for watching, and if you found this helpful, please subscribe to stay tuned for more in-depth corporate decoder videos.